Hi, Greg Weldon here with WeldonLIVE for Wednesday, December 12th. And today, say hello to the new boss, same as the old boss. And in this case, the new boss is the old boss. And in this case, the old boss is the new boss. And the boss is gold. Gold, like a boss. Bottom line, gold on the verge. Silver now potentially in play here. We see the whole dynamic evolving now. You hear more and more people talking about Fed one and done. Maybe they don't even go here. People talking about no hike in 2019. Paul Tudor Jones, one of my all-time idols, way back with Tudor in the 80s when I was a broker at Lehman. Louis Bacon was Paul's broker, and I was tight with Louis. So, bottom line is much respect, obviously, and, one of the most brilliant minds in the business in history, Hall of Famer, hey, the Fed's not going to hike next year. I mean, we've been saying this for a while. I mean, we've been saying this all the way back into August when the Fed funds rate, couldn't even get through 3% for next year. And when we said it's a bridge too far, August 29th, if the Fed were to hike rates in September, it would bring the stock market under pressure and would cause them to have to rethink, and that maybe they wouldn't hike in December. And the 2.25 could be a respectable, acceptable for now, neutral rate. You could go to 2.5. We said 2.5 when this all started. We thought it would get to 2.5. But as you're getting here, you don't have to go there in a straight line. And the degree to which inflation is falling, it's moving away from their target. They want to be asymmetric. Well, then that means they can't be tightening when inflation is moving away, clearly trending away, not just moving away, but beginning to trend away with momentum away from their target. That would, by definition, say they're not hiking rates here in December, but they will. It'd probably be too much, and then we'll see what happens. But when we talk about Europe, and we've talked about mainstream Europe, core Europe, second-tier Europe in terms of the first derivative off of the German export juggernaut, Czech Republic, Hungary, so on and so forth. And then we talked about Northern Europe yesterday. All right? Inflation rates are plunging. Okay? The bond yields are breaking down, and yield curves are flattening. Okay? And I meant to put that in here. I didn't even work that in. And when you have this dynamic around real yields being so deeply negative and nominal yields like the Swedish 5-year going back into negative territory nominally. I mean, come on. China's wobbling. Italy and Spain are fracturing. Real growth in Germany is gone. All right. Credit growth all of a sudden hits this real slowdown in Japan. Global stock markets are crumbling. Curves are flattening and bond yields are breaking down. I mean, holy mackerel. The Fed's going to keep pushing? Well, at the end of the day, we know the consumer situation, we know the household wealth situation, and we know the situation with the ECB and many of the central banks. So they have no policy options. All right? So it goes back to the Fed. And I said this in August, we said this in September, we said this in October, we're saying it here again in December. God, is it December already? Oh my gosh, I thought I was going to say November, but it's already December. I mean, how quickly this whole thing is playing out, how quickly it's, moving, and how time is just flying, but how everything is converging here. It really is crystallizing, converging. We can use a lot of analogies, all right, to where the dollar is, always was, always will be, has been the relief valve. Okay, Fed can't turn and cut rates. Somebody on CNBC today was talking about, or yesterday was talking about the Fed is slowing down the pace of shrinkage in a balance sheet. I mean, that's not happening. The Fed has already told us way back that when they're hiking rates so they can use rates instead of having to use the balance sheet. But this is the kind of thought process out there. The Fed is not going to be able to turn on a dime here, let alone that they may not even stop hiking rates. I mean, the policy error risk here is huge because Powell, first under political pressure, may not want to look like he's folding. And I said right away, after Powell's last gig, that one and done in December. They're going to hike one more time and then make it clear they're done so that it's not like, well, there's any question about another one. Okay? But we don't know that. I mean, Powell is a student of the 70s. All right. This leads to the dollar being the relief valve, as it always is, and leads to the thought process, can gold appreciate in all currencies? And we are evolving towards that. We have the evidence. Let's take a look. Norwegian, a little bit of backtracking, but it's important to the flow of the story. Norwegian CPI, 3.5, new high. Outperformance in many places. Now, this is one place where inflation is rising, and there's a reason I'm using Norway, okay? But, broad-based with a lot of sectors above the headline rate, okay? Breaking out, and even core at 2.2. So, core has not been above 2, all right, for at least a year, all right? So, and accelerating here. It's doubled in the last 5 months, okay? And, the bottom line, inflation here at 3.5, again, 2-year high. In that vein, okay, you've got inflation on the rise, and not expected to be rising, is rising. 2.2 on core, 3.5 on the headline, and the 10-year bond yield's breaking down below 2. What does that say? It speaks volumes, and you see, a lot of this has to do with everywhere else. Inflation is coming down, but nonetheless, the dynamic here is the uptrend line at risk of being violated. The 52-week moving average already violated, and now the 2-year at risk. Breaking down big time. The krone breaking down as well. You see the trend line's been violated. The moving average has flipped back to the upside for the dollar, meaning downside for the Norwegian currency. And at the end of the day, what happens? Gold price and krone breaking out big time. Not far from its record high, which was set in 2016. Norway, Sweden, Denmark, these central banks, have been as aggressive in terms of QE and as aggressive in terms of negative interest rates as anyone out there. And here you have gold breaking out in Norwegian krone. You also have the dynamic in terms of sterling coming unglued to the downside here. Note the moving average, by the way. Never turned bullish. This has been bearish this entire time. And all of a sudden, gold priced in sterling, which looked like it might be breaking down, is now breaking out. Okay? And these highs are in play. 1055 and 1170. They're not far away. And in this case, when we look at, for example, the terms of the gold in sterling, look at the moving averages here too. In terms of sterling against the U.S. dollar, the moving average has never turned to the upside. And in terms of gold in sterling, the moving average has never turned to the downside. And now they're realigning and widening on the bullish side. Gold breaking out in sterling. Swedish krona. Now, this is either the mother of all head and shoulders tops for the dollar, or the krona is about to break down in a big way and really plummet here. Of course, that plays in with gold. Gold price in Swedish krona. Again, the Riksbank's been one of the most aggressive central banks since 2009. On the verge of a major breakout. These levels up here, I call them dead man walking. You're about to break out through major key upside technical levels that include the record high from 2011 in gold priced in krona. And to me, this is a sign of things to come, a preview of things to come, like everywhere, including the U.S. Just to touch base on it, the renminbi, this is a big moment for the renminbi. Either this is, a major double bottom off of the 38% retracement, and this is still the trend, is renminbi higher, all right? Not that we think it's going to make new highs. Or it cracks, and that's it. And this is big time. The dynamic around the economy and the credit situation and, the markets in China might imply that you are at risk here of taking this level out. We thought that was the case when we were up here. We're going to 7.25. It has not played out that way, not yet anyway. So we'll see. All right, but this will be important to note because you have the defining points right here. 683 and 697, clear cut. Next move is a big move, and in this vein, all right, when we look at gold priced in renminbi making a new high up here, breaking out. All right, rolling up. It's violated the trend line. It's rolling up here. It's had a very well-defined Fibonacci correction. It's almost like CBA. All right, it's almost the reverse ABC. Kind of cool. Trend line. The 5-year moving average, violated, turned up, supported provided support. Now you're at new highs. This more than anything tells us. really, there's a growing level of discomfort in holding any paper currency. All these countries with all these debt, and now what, they're going to have to do this all over again if you get a recession, because central banks have no room to cut interest rates except for the Fed. And the Fed is hiking rates. And the next medium-term move is by default the next long-term move, because you are so coiled here in gold and renminbi, and this is huge. This is just huge. So, does the Fed hike again and risk a further extension here in the dollar, which would be a major breakout? And all these, emerging market currencies that have had some stability all of a sudden don't. How does that work in favor of their goals, of their mandates? It doesn't. It doesn't. So it would be a policy error, but nonetheless, there is some risk to holding gold, that the dollar becomes the player here again to the upside off a tight Fed, off a really hawkish Fed. But to me, it's more a policy error, and gold becomes the go-to. Because you want to hold treasury bonds? The Fed's shrinking their balance sheet. They're at 400, not even 400 billion. They got another 200 billion to go just to get to the 600 billion a year pace they want to be shrinking. So they can use it again on the back end somewhere down the line for QE4. Well, after rate hikes have run their course. The Fed has done the masterful job here relative to the ECB, relative to the BOJ. The PBOC and the Fed, and maybe to a very, very small degree, Australia, Canada, and UK, have some room, but that's it, man. And in terms of beginning to rally in all currencies, this is huge. All right, here's the dollar index. ABC makes a new high up in here even in the last 3 weeks. The dollar, the gold adjusted value of the dollar, in other words, dollar index divided by gold, pretty simple ratio, did not make a new high. This reached the 61%. This barely got through the 50% and couldn't make a new high here, and now is below the 52-week moving average already. Rolled over here a while ago. All right? On the longer-term picture, didn't even get back to the trend line it violated. This is subpar rally. It's corrective, and now you're breaking down. You're below the 2-year moving average here. And in terms of the long term, and this is it. This is what we talk about. Almost by default, with every other central bank outside of maybe the PBOC, for all intents and purposes, paralyzed. All right, the dollar becomes the relief valve, like it always is. And going back to August of 1971, when Nixon closed the gold window, 85% depreciation since the high in 1975-76. You're down 92.4% at this level, not at the lows, at this level. New lows are imminent. New levels of depreciation are imminent. I would say imminent, are inevitable, and that to me means, a move through 1377 in gold is also inevitable, and, a run higher. So I'm going to go back. I'm actually working on a new book, believe it or not. My publisher, Wiley, has been after me for a long time to write a second book after the Gold Trading Bootcamp, so I have begun that process. And what's interesting within that context is going back and doing some research. This is a bit of an old sheet. So these numbers are low. These are conservative estimates relative to the debt and money supply that has been created since I put this together in July, August of 2016, a presentation to the Tiger 21 Club, some of the most influential and wealthy investors in the United States, in the world. I think the minimum buy-in there as a club, is a $100 million portfolio. And then for a Real Vision TV special I did in August of 2016 on gold, let's take a look at the math, because what we're talking about is this right here. The dollar is the relief valve. More print, more dollars, and boom, boom, boom. So what is the value of gold here in today's market? And this will understate the value of gold. Keep that in mind. These numbers understate the money supply and will understate the value of gold outside of the Fed's balance sheet, which is obviously shrinking. All right. So here's the numbers: money supply, debt, government debt, derivatives. Let's not even talk about derivatives. Because it's a murky area, nominal versus notional versus the risk dynamic. It's a little murky. But sticking with this, the facts we have about gold held by central banks, the known above ground supply against all the money. All right. The idea is here, what's a fair value for gold relative to gold, relative to a dollar that's down 85% since 1971? Well, if you go off currency in circulation, which is a very low measure of actionable money out there, as we know, more and more every day as money goes digital. But, you're talking about just to kind of have a gold standard just for currency and circulation, which falls well short of being a gold standard. The gold price would have to be $5,500 to back it. And then you go all the way down the line, where if you want to do total broad money supply in the global money supply, we're not talking debt, we're not talking derivatives, we're not talking any of that. We're not talking, it'd be much higher for sovereign debt. Just global money supply. All right, they talk about a 50% would be a decent gold standard type of thing. That's $44,000 an ounce. All right, now we're not saying you're going to $44,000 or $87,000 an ounce. We're saying you could make a very solid mathematical case to suggest gold is wildly undervalued at $1,200. And this is why I'm writing the book. You have consumers borrowing against unrealized paper profits in an asset they think can't go down right now against the stock market, unprecedented consumer credit growth, especially in credit cards, relative to what we saw in 2005, 6, and 7 when they borrowed against their mortgages in their homes. Same exact dynamic, different collateral base. All right, now, again, thinking stocks can never go down just like real estate could never go down. I mean, foolhardy, short-sighted, and to the extent to which household wealth is now tied in to equities more than any other time except June of 2000, right before the tech bubble got crushed. I mean, come on. And I wrote the book in 2006. It was published in 2007, and the point was gold is undervalued, and they're going to have to do more monetarily because you have problems coming down the pike. We're right then. I think we're right now, and it's the same type of setup logistically for all intents and purposes. And at $1,200, gold is as undervalued now as it was in 2006 when it was trading $450. It wasn't even yet $500. And here it is, bullishly positioned. Long term, love this. I mean, it's almost like a time-space continuum. The age of Aquarius started in January. Jupiter aligned with Mars in the 7th house and so on and so forth. We went from Pisces to Aquarius in terms of the 25,800-year Mayan calendar cycle relative to the orbit of the solar system around the black hole, the center of the Milky Way. I mean, these are all numbers. And the dynamic around what you see here just ties in, to the tightness of this technical pattern for its long-term, meaning, which is huge. And, suggests if you get above 1377, meaning dollar below 94, it'll happen. The count gives you at least 2450. That's what we're talking about. So American Barrick was our top pick, continues to perform, breaking out. I mean, through 1410, this is a well-confirmed breakout. And longer term, I mean, American Barrick, even at $14, is about as cheap as it's been in the last 3 decades, man. I mean, think about that. It's like, oh gosh, well, we can't buy it at $14. It's, up from 10. It's already up 40%. So what? Okay? It's $8 from its low and $42 from its high. We know the skew in gold is not even close to that. These mining shares are dramatically undervalued. Are they investable? Maybe not, but we're going to talk more about that in a minute. Seabridge was one of our focal points, had the big rally, was outperforming. It came all the way back down and held where it needed to. Still looks really solid. Anglo Ashanti, say what? Breaking out? Say what? Breaking out. Straight up, this could be a sleeper because this thing, to get back to the 2016 high, would double. And it's a pretty tight technical pattern. Wasn't an underperformer, though, so it was a little riskier there. Newcrest, love this pattern. Oh, my God, is this tight or what? And about to break out in a big way with a lot of momentum behind it. And look at these moving averages. Been bullish the entire time. Never even touched, threatened to go bearish. And it's a Fibonacci, higher low, beautiful setup in Newcrest. Rand Gold, approved now, the merger with the takeover with ABX. Costs were down, so earnings were up, although production was down. But frankly, I think that's kind of a bullish thing for gold overall. We see production from South Africa was reported too. Big, another double-digit year-over-year decline, multiple months in a row now. Breakout in Rand Gold. Newmont, outperformer, stagnant, underperformer, meaning outperformed to the downside, now laggard, and about to break out, ready to rock again. Looks pretty good. The junior gold miners. I mean, waiting for Godot, or will patience pay off? We'll choose the latter. They got the last gasp of liquidation. I mean, I don't know that you can take the on-balance volume much lower. And when you see this kind of double bottom, I mean, in the SIL and a lot of other things, you made a lower low here. You didn't in the junior gold miners. That to me is significant. 30, 31 would be a major breakout pivot. I mean, you got all kinds of stuff going on here. You get through 31.75, you're through the 2-year moving average with huge bullish divergence. There's a lot going on here. Silver, kind of wow, out of kind of almost nowhere. It did make a new low, but then comes roaring back. It gets through 14.95. It sets up for a test of more significant overhead resistance, and we want to like silver above 14.95 because look at the gold. Look at the long-term picture. I mean, this thing is just, man, like the beach ball held underwater. And the volatility is low. You could be buying call options. Potentially some, term dated call options with $16, $17, $20 strike prices. Probably on the cheap. I'm not a real options guy. I don't like paying away premium. I'd rather just buy the futures. But for those that are the options guys out there, I mean, man, now's the time to take advantage of what is a rare bout of low long-term volatility in silver. The silver miners did make a new low and come bouncing back and threatening the downtrend line. Goes all the way back to 2016 with a major double bottom and huge bullish divergence here too. Pan American. Now we said it might break because we thought you might get a bout of liquidation. You got it. You got it. And not only that, but it held precisely on the 61%. I mean, within pennies. A, B, C, 50, 61% sets up. Here's the 2-year moving average right on top of this high. You get through that level 1575, that's your bull sign. We still like Pan American. And then the nugget. I mean, I really think this is a way to leverage the heck out of gold once we, are really kind of, confirmed in that it's, what we think is going to happen is happening. And right now what we think is what's going to happen is happening, all right, as it kind of breaks out in all currencies. It flexes some muscle. 17.15 is huge because at that point, you are going to 21.24, and if you're going to 21.24, you're going to 27. So, and this is a triple leveraged risk capital, buyer beware. Do not mess with this if you are a neophyte. Just don't, And then we note Sandstone. Now, I'm not an expert on this company, all right? So I'll preface it by saying this is not my bailiwick, so to speak. They do financing, they get revenues, they plow the money back into the share. I mean, in a market that has been deemed investable for, and that's a valid thought process in some ways. I mean, it's an investable market, all right? So in terms of Sandstorm, okay, they don't basically run their own mines. They invest and then take royalties and back-end payoffs, right? So 20 currently or in development projects, all right? They're 60 million cash flow positive, expecting that to double, okay, by, I think it was 2023, 2023, all right? And all of that, I mean, you're at 70 million now, all of it's going into buybacks. I mean, it's interesting. I don't necessarily have a problem with that. Maybe I got to think more on this one, but I find that to be really interesting strategy. All right, here's the mines and the amount of ounces of gold that it's currently producing, and this is set to rise pretty substantially with this mine in Brazil that they're big on and have a nice back end payout. Cash cost is low, relatively speaking. So interesting, kind of short mine. I thought this was interesting, but they're thinking they can really expand this. So it's a short mine life and not a huge amount out of the ground, but it's profitable and it's interesting and it's a cash flow positive that will, pad the bottom line. That'll go back into the shares. Talking about silver now too, an Argentinian silver mine will be producing silver. Royalties will be paid. So maybe a little more due diligence on this one. The risk is broad-based in terms of, places around the world geographically. All right. And the price action is not too bad. All right. Looking for a long-term uptrend breakout. And sticky fingers hold this. You don't really see much dumping of this throughout these periods of weakness. And frankly, I kind of think this is a good idea. A lot of buying on these low points. Again, I'm not an expert on this. There may be some things I'm overlooking. I'm going to do some more research into this. But, from the amount of work I did on this today and from some of the knowledge I have from prior, this doesn't look like a bad potential alternative, Sandstorm Resources. No new trades today. Still watching corn and still monitoring all our trades. Natural gas, crude oil still on the hook for potential exits here So keep an eye on that, and we'll be make sure to update you if we have any changes to our existing positions.